Hey guys, today we're going to be talking about a different way of looking at return on capital. Let's go. Return on capital is a very broad term. You have a very large amount of formulas for it. You have ROC, ROIC, ROCE, you name it. In order to come up with a formula that suits your needs, you need to ask yourself, what am I trying to measure? Before that, let's take a look at how the experts do it. In this case, we'll look at Joel Greenblatt's approach. And this is a quote from The Little Book That Beats the Market by Joel Greenblatt. He says, the formula looks for companies that earn a lot compared to how much the company has to pay to buy the assets that created those earnings. So my interpretation of what he says is that he's trying to isolate the business operations, and by doing so, he's trying to also find how profitable those operations are. Um, you also have an image on the written posts at stockpickinginsights.com. That image shows the actual formula, which is EBIT divided by a sum of two components. The first one is net working capital, and the second one is net fixed assets, and both go into the denominator. So EBIT in the numerator and these two in the denominator. It's also from the book, the little book that beats the market by Joel Greenblatt. But why these measures? According to him, he uses EBIT, so returns on capital become comparable across geographies. And he uses net working capital plus net fixed assets. He calls this the sum of these two tangible capital employed. He uses these two as a measure of the assets needed to operate the business. So, in a nutshell, it seeks to measure how good the business is. So, what's the problem with this approach? There is no problem unless you are trying to measure something that this return on capital can't. And that's why we need to ask, what are you trying to measure? Joel Greenblatt's return on capital serves a purpose, but it doesn't judge the management's ability to deploy capital. And to do so, we need to take a look at more than the capital employed. We need to also take a look at capital not employed. And to do so, we must account for assets like cash, liabilities, and inside the liabilities, you have, for example, debt. And my point is to measure a company's business profitability and also the management behavior, we need to use a different return on capital. And this leads us to other state of the art formulas, such as return on equity or return on capital employed, ROE, ROCE, which uses equity and equity plus long term debt, respectively. We are now, by using these two measures, we are now accounting for leverage. Meaning that we've now stepped across the line. So we are now partially measuring the management's behavior, unlike we were doing before with the Joel Greenblatt's formula. And this is because, for example, some managers choose to use more debt than others. So by taking debt into account, you'll see some of these management behaviors. Okay, so we started with Joel Greenblatt's formula. We then stepped into a formula, two formulas that use more things in the denominator. They use equity or equity plus long-term debt. So are the last ones okay for what we are trying to measure? Yes, they are, but they are not conservative enough. So we can be more conservative than this. Remember the question, what are we trying to measure? We've stopped measuring the business in isolation. This was perfectly measured by Joel Greenblatt's formula. and we shifted from that formula to how good the business is plus how it is managed. Uh, ROE, return on equity, and ROCE, return on capital employed, is not conservative enough because there is more capital to be used than long term debt or simply equity. For example, what about account payables? Those are also available capital. As Joel Greenblatt says, it is effectively an interest free loan. So, account payables is considered an interest free loan. The same goes for deferred tax liabilities, deferred revenue, and so on. So, because I am more conservative, um, I like to use a different approach, and here's my proposal. I propose return on capital to be in the numerator, so on top. I propose to be net income. If you want to compare across geographies, you can use EBIT, but I use net income or the smallest between net income and free cash flow, and I divide it by total assets plus total liabilities minus some adjustments that we will talk in a bit. And what's the big difference between this one and the ones that we were talking about? The big difference is that liabilities are a plus in the denominator, and this is similar in a way to return on capital employed because it also uses long-term debt in the denominator. But by the way I'm doing it, you not only add long-term debt, you add all the liabilities, so everything goes in. Regarding the adjustments, adjustments are goodwill and capital lease liabilities. And why do we adjust for these two? Goodwill is purely accounting. It is not money available to use. And capital lease liabilities are also subtracted from the denominator, because if you didn't do that, those capital lease liabilities will go in twice in the return on capital calculation, because you have lease assets and lease liabilities, and we are summing all assets and all liabilities. So we subtract one of them. They are not equal, so there's a minor overstatement by subtracting the capital lease liabilities, but I don't consider it significant, so I do it that way. And should you subtract intangible assets from the denominator too? Intangible assets are surely valuable. For example, if you buy a patent, it costs you money that you could have allocated elsewhere. So it shouldn't be adjusted for intangible assets because there is money that was put into those intangible assets that could have gone elsewhere. If you overstate those intangibles, no problem. It penalizes return on capital, and that's conservative. So if the intangibles are different from their fair value, meaning higher, it won't be a problem. It will just show a low return on capital, but on the conservative side. So to end, my proposal for return on capital is meant to measure not only business operations in isolation, because Joel Greenblatt's formula does that perfectly, but also capital allocation ability. So how the management conducts the business and allocates capital. A company that has parked cash gets a lower return on capital. Deferred revenue and deferred tax liabilities will lower it too. The same goes for example, high accounts receivable, and that means a company that gets paid slowly. And why should we consider high accounts payable to be bad? It's simple. It's because if the company isn't getting the money quick, like a supermarket, for example, it isn't turning inventories to profits as well as a company that gets paid early, such as a supermarket. Um, Also, anything that goes into their balance sheet will lower their return on capital, and deservingly so. It is capital that they can put to use, so it measures how good they are at deploying that capital. The difference between the formula I'm proposing and other formulas is the denominator mainly. This, of course, favors asset light companies, so companies with small balance sheets. For example, Facebook has a return on capital of almost 20 cents on the dollar, and that means that if you would give Facebook a dollar, they would make 20 cents with it. Alphabet hovers around 10 cents, so you give them a dollar, they make 10 cents. It means that they make around 10 to 20 cents with each dollar of available capital, and that represents yields of 10 to 18%. If they can keep reinvesting in such great businesses, this is what we should expect in return. So we also need to look at where are they reinvesting those profits. But that's a topic that was discussed in another podcast, so you can check that one out. And that's it for today, guys. We'll see you next week.